We are taught from a very young age that the safest place for our money is inside a standard bank account. It feels inherently secure because the math is simple and static. If you deposit $10,000 today, you will log into your account a year from now and see that exact same $10,000 sitting there. The numerical value never goes down. However, focusing exclusively on that static balance creates a significant blind spot. While the digits in the account remain stable, they are disconnected from the shifting economic environment outside the vault. In modern economies, the baseline cost of everything, from rent to groceries to energy, is constantly moving upward. This steady erosion of your money's purchasing power is called inflation. It dictates that the same dollar buys you slightly less milk or gas today than it did exactly 1 year ago. While a standard savings account might pay a tiny fraction of a percent in interest, that fraction rarely keeps pace with the rising cost of living. When you factor in inflation, the reality is clear. Stagnant money is not actually standing still. It is actively moving backward in real-world value. To simply tread water and maintain the lifestyle your money buys right now, your net worth has to grow at a faster rate than the inflation dragging it down. This chart shows exactly how that math plays out over a lifespan. The flat, slowly rising linear line representing your cash savings is eventually caught and overtaken by the steeper cost of inflation. Outrunning this requires an entirely different trajectory. Escaping that linear trap requires moving from passive saving to active investing. At its core, investing in the stock market means purchasing shares to acquire a small ownership stake in a public company. This ownership provides two distinct paths for growth. The first is capital gains, the profit you earn when a financial asset is eventually sold for more than its original purchase price. When a business successfully expands its sales and increases its bottom-line profits, investor demand for a piece of that success increases, driving the share price up along with it. The second growth lever comes in the form of dividends. These are reliable, often quarterly payments made by established companies to distribute a portion of their net profits directly back to their shareholders. Think of dividends like a steady drip of water nourishing a crop. They generate a consistent stream of passive income, providing steady cash flow while you fully maintain your ownership of the underlying asset. But if you pocket those capital gains and dividend checks as cash, you severely limit their potential. Taking the money out keeps your wealth building restricted to simple, linear addition. Federal bank data shows compounding reinvests returns to grow investments. Depositing 1,000 rupees at 6% earns 60 in year 1. Year 2 applies 6% to the 1,060 total, earning 63.60. This snowball effect multiplies returns, bending a flat line into an exponential curve. When you zoom out, you realize that the ultimate factor in a portfolio's success relies heavily on a single variable. It is not just about picking the perfect asset, it is about the duration that money remains invested. Over the course of a few decades, the primary driver of your portfolio's growth completely shifts. In the beginning, progress relies heavily on your initial deposits and early market gains. But as you reach the later decades of your investment timeline, the mathematical reality changes. The compounding effect grows so large that it overtakes your principal entirely, becoming the dominant engine generating your wealth. The practical application of this math is straightforward. The earlier you begin saving and investing, the more time your money has to execute this cycle. More time in the market physically steepens the exponential curve. Sustaining a portfolio over decades is a mathematical necessity for outpacing inflation. It relies on early, consistent action to push money off a linear path and onto an exponential curve.